Okay, this is Financial Planning 3600. Welcome to the recording for Chapter 11 on retirement planning. This is a very high-level overview of both, excuse me, accumulations and distributions in retirement planning. This is the last chapter on Exam 2. So, couple of terms that when you're in most retirement planning situations, you will need. Most people use these terms inside the industry. This is not something that you would terms that you would use when you're speaking to your clients, but if you talk about and when you're inside the industry, and only really if you're talking about trying to do these calculations, so of time value of money. So really what we're looking at is work life expectancy. That's the time left remaining between your retirement age minus your current age, or RWLE is the same thing. And then there's retirement life expectancy. This is your estimated life expectancy minus your retirement age. Certainly we'll use those a little bit more as we get into some examples later in this chapter. So certainly starting to save early is important. This is a time value of money concept, that the earlier you start to save, the less you have to save overall. And so we'll see an example of this here in a minute. So here's just sort of some guidelines. I'm not going to make you memorize these. The investment assets as a ratio of gross pay needed at various ages. So you need to have about 20%, saved toward your retirement of what you make. If you're making $50,000 a year, you should probably have $10,000 saved toward retirement. By the time you get to age 35, you need to have, if you're making, still making say $50,000 a year, you need to have somewhere between $80,000 and $90,000 saved by the time you get to age 55. Let's say by that time maybe you're making $100,000 a year. You would need to have somewhere between $800,000 and $1 million saved, and by the time you retire, you'd need to have somewhere between 16 and 20 times your annual earnings saved. And we'll see that this is kind of based on some assumptions. We'll get to the 4% rule here later in the chapter, but we'll also see how we'll get to another number, wage replacement ratio, and this will make a little bit more sense, particularly when we tie it together with the 4% rule. The savings rate is the average savings amount divided by your gross income. So it is a percentage of disposable personal income. If you've ever heard the term, and I know you have in this class, pay yourself first, it rather than treating savings as disposable income, in other words, we spend what we have to spend and then we save what's left over, we decide what our budget is that we can afford to spend by saving first and then deciding, okay, how much do we have to spend on housing and so forth and so on. So here's an example. This is a vignette that you'll see, and I want you to be able to understand it, understand why it works, and be able to explain the significance of it, what makes it work the way that it does. So Lori saves $2,500 a year from age 25 to 34, so 10 years, and invests the money in an account earning 8% annually. Lori stops saving. She just saves for 10 years, but doesn't take the money out and then just lets it grow until she retires at age 65. But Peter saves $2,500 a year from age 35 until age 65. So that's for a period of 31 years, and he earns the same thing. So even though Peter saves, Peter over that period of time is actually 31 years times 2,500. he would have saved $52,500 more than her. He will never be able to catch up by the fact that he started 10 years later, even though he saves over 3 times the amount of money that she saves. So we say that $2,500 for 10 years, $25,000, $2,500 for 31 years is $77,500. At age 65, Lori would have $393,588. Peter would have $308,365. Let's look at what this looks like on Excel to see if we can figure out, and I actually put the wrong amount in there. Say that Lori's saving $2,500 a year, and we'll also have Peter saving that as well. Okay. So we can see that Lori at age 65 would have 393. Peter would have 308. It's not even really that close. She would she would have about 30% more money than he does. So why is that? So we can see that Lori saves. She saves at the end of the year. That's what we're assuming. So she doesn't earn anything on interest the first year. She saves $2,500, and she has $2,500 in her account at the end of the first year. But if that amount then grows by 8%, that will get her to $2,700. She saves another $2,500, and she has $5,200. This is compounding. This is time value of money, so forth and so forth. So by the time she has saved 4 years, she's got saved a total of $10,000. Interest is about $1,265. By the time that she gets to the 10th year of savings, she saved $25,000. Interest, total compounded interest is earned is $11,216. What's the difference though? So she stopped saving here between 34 and 35. So all of the growth comes from interest earnings. We can see that it's almost $2,900 in interest earnings. So that equals more than the amount that Peter will save. That's the key amount. That equals more than the amount that Peter will save. So by that point, and this happens for everybody that saves for retirement. There will be a point if you save consistently at which you have an average year in the market, and you'll see that you're returning the amount of money that you return in the market will equal more than you save. Of course, you should continue to save, but it wouldn't matter if Peter saved forever. He would never be able to catch her. You know, if he saved, you know, all the way down here, he's saving that. She's growing. The difference is going to grow larger and larger. Here at age 65, the difference is, you know, about $85,000. Let's see what age this would be. Just 8 years later, the difference would be about $130,000. So the difference is going to keep growing over time, no matter how long Peter keeps saving, because he's never going to save more than the interest that she's earning. So I want you to be able to understand the value of this and be able to understand the key is because the key to the value of saving early is because versus delaying is because the interest earned is more than is what is saved. And this happens somewhere typically in most investments, somewhere between the 8th and the 12th year. Most long-term investments where you're earning, you know, 6, 7, 8, 9%, assuming that you continue to save the same amount. Okay. Certainly a test question. Okay, I think the what you have on your what you have in this handout actually has small cap stocks versus in small cap stocks. That was a typo. This one should actually, the second category should read large cap stocks. So historical returns. Small company stocks have averaged about a 13% return. So a couple things I want you to pay attention to. Have averaged about a 13% return historically. Big company stocks have averaged about a 10% return historically. The higher the return, the higher the risk. So standard deviation is inflation here. Don't pay attention to the risk and return on that. Really just pay attention to the risk and return of the top 4 categories. So large company stocks have averaged about 10%, but lower standard deviation. Corporate bonds, aggregate corporate bonds have averaged 6% with a 9% standard deviation, a little lower. Treasuries, backed by the full faith and credit of the United States government, have averaged 5.5% return with about a 5.5% standard deviation. So understand this too. This kind of shows the eroding power of inflation-adjusted returns, particularly when you're talking about bonds. Bonds, the interest that you pay on those is taxed at ordinary income. What happens is that the taxes tend to happen on the nominal returns, and then inflation takes into effect. So if we have a tax rate on, let's say, the 6%, on the 6% bond, and let's say that we're paying effectively a 30% tax, so that would take us down to 4.2. If we had an inflation-adjusted return, if we had an inflation adjustment, that would take us, an inflation adjustment of 3%. That would take us down to a real after-tax return of 1.2%. Short-term treasuries, after you pay the interest, historically have trailed inflation. This is, probably on average intermediate-term treasuries. But if you look at the really short-term treasuries known as treasury bills, less than a year, historically after taxes they trail inflation. So it's not a great place to grow your money long-term. So as it relates to retirement, if you can stomach the volatility, and we talked about in the investments lecture the importance of risk tolerance. If you can stomach the volatility, it makes sense to invest in mostly in higher earning asset classes. Of course, the risk is that the roller coaster when it's at its trough, it's at the bottom, and then you won't get the higher expected returns. So one important thing, there's several approaches that we can use to reduce risk of outliving our money. Longevity is a major uncertainty when it comes to retirement planning, and this is the area where I focus my research. So there's a 4% approach that basically says, hey, if you start off with $1 million, you can afford to take out $40,000 the first year, 4% of your value at retirement. Take it out at the beginning of the year or quarterly or so forth and so on each year, and you'll actually be able to increase that amount by the amount of inflation. So you do $40,000 the first year, and then you do, inflation's 3%, you do $41,200, 42,500, so forth and so on. The money for life approach is not nearly as famous as the 4% approach, so I won't even ask you. About that one. I don't think it makes a lot of sense. Okay, in terms of retirement needs, particularly when you're doing planning for people who are approaching retirement, we need to, I think it's a pretty good estimate of what it's going to cost somebody to live in retirement based upon what they're spending now, and then making some adjustments and ups and downs. So if we consider the gross approach, we say, okay, hey, we are no longer making Social Security payments out of our payroll taxes once we retire. In fact, we will be receiving Social Security instead of paying into it. We won't be saving for retirement. We'll actually be taking money out, so we don't need to budget in a savings account. We're not going to have work-related expenses, whatever it costs us to commute to and from work each day. We're going to have some other expenses that are going to increase this, but we're just going to focus over here on the left side. At some point in retirement, if not before we're at retirement, most people will have their mortgage paid off, and then auto insurance may be reduced if you drive less. A married couple may need to, because they drive less, may need to buy cars less often. They may ride together more often, things like that, so you get less wear and tear. And so there may be less work-related entertainment, but now that you have more time off, some expenses are going to go up. So we're going to have, in terms of lifestyle changes, people, particularly in the early phases of retirement, at least this is what they would like to do. They'd like to be able to travel more and have second homes. They're going to have more time to do hobbies, and hobbies end up costing money. And stuff like that. So property taxes may be higher due to inflation, although in some states people get in retirement get their property taxes frozen, get a little bit of a break. Typically, people, as they're retired, they end up having increased, and that's not necessarily due to retirement. It may be just the phase of life when your grandchildren are getting older. So there's more travel to see grandchildren, and there are more gifts that people give. So I think the question is whether you plan pre-tax or after-tax. Here's this assumption here is that most planners who are not CPAs plan in pre-tax dollars, believing that's what their clients understand. That hasn't been the way that I've done, and that's not the way that I teach people how to do it. I want you to be able to understand it both ways and understand that the important thing is consistency. So if we are planning with pre-tax dollars, if we are planning with pre-tax dollars and then we're going to make an adjustment for spending, then we can use a pre-tax rate of return. If we're planning with after-tax dollars for our goal to spend in retirement, then we need to do an after-tax rate of return. And so it's based upon the assumptions that you use. I think it's best for financial planners to talk to clients in terms that they think about. When you ask people their annual income, they think in terms of the gross number, the pre-tax dollars, pre-tax and pre-anything coming out of their check. When you start asking them maybe about how much they bring home each month, they think about after all the deductions are taken out. And certainly, I believe when you start asking them about their expenses, money is spent after taxes. So if you're looking at that, I think most people think in terms of, I think the most common denomination time denomination that people think about is their monthly expenditures. But I think when you're asking people what they spend, think about how they spend it. How they spend reflects how they think about it. I think people go out to eat and think of groceries almost on a weekly basis. On an average week, how many times do you go out to eat? They spend money on vacation, and they might think of that more in terms of annual terms. Well, I take a few short trips a year and one big vacation. Okay, well, I spend maybe $500 on the 3 short trips and $5,000 on the vacation. Okay, that's $6,500. I can convert that into an average monthly expenditure. And people think about home improvements and major home expenses. Oh yeah, a few years ago we had this, a few years ago we had that. We need to budget these things in. So talk to people about how often in the last several years, or in the last 10 years, have you had to have some major home repair expenses, and what they are anticipating in the next several years. Talk to them, as I said, on their weekly expenses. Talk to them weekly. On their monthly expenses, most bills are stated monthly. I think you can talk in monthly terms. And again, almost all of these expenditures are going to be after-tax dollars. So the wage replacement ratio, particularly when we consider on after-tax and after-savings basis, the wage replacement ratio, we don't need as much to live on after retirement as we do before retirement. So if we had an 80% wage replacement ratio, if a client in the last year of work makes $100,000 and then $80,000 in the first year of retirement, that is an 80% wage replacement ratio. So here's how this might be done. We can say, okay, $50,000. If I make $50,000, I'm going to subtract out the amount that I saved for retirement. So I save $5,000 a year for retirement. That goes to $45,000. The payroll taxes that go towards Social Security, I'm not going to have those taken out of my check. Again, if we're thinking in gross terms, so that's going to take me down to $41,175. So my wage if I spend the same on everything else, my wage replacement ratio is 82.35%. If we were to subtract out mortgage, if we were to subtract out life insurance and disability insurance, and then add some things back, you may add some things back in terms of increased travel and things like that. You might end up with, down to 60 and then back up to 75%. So the wage replacement ratio is a top-down approach, and I think this kind of makes sense if we're planning for people, in a long term in the future. The bottom-up approach is also called the budgeting approach, and I think that this is the one that makes sense. The budgeting approach focuses primarily on after-tax dollars, and we say, here's what you're spending now, here's what your cash flow is, and how are these things going to adjust. I think that the bottom-up approach is a much better approach. The wage replacement ratio is more of a rule of thumb type approach. So we can say, okay, here's some adjustments that we would need to make. After we say, hey, here's what you're spending in all these areas, here we could say, oh, what are the adjustments that need to be made, and we can do that. So, sources of retirement income. This is basically, these 3 bullet points make up what advisors a generation ago used to talk about as the 3-legged stool. You got Social Security, which acts as a paycheck. You get a paycheck until you die. You got a company-sponsored pension plan, and that acts as a paycheck until you die. And I'm going to put the retirement plans that are defined contribution plans, where you don't get a check until you die, I'm going to put that under this 3rd leg of the stool, personal assets and savings, because they act the same. Personal savings, IRAs, and 401ks, things that you save that money up, and then you have a big bucket of money when you retire. So we used to have basically two paychecks and a bucket of money. As pensions have declined, pensions were much bigger 30 years ago than they are today. As pensions have declined, and so the Social Security system, in terms of the wage replacement that it offers, has decreased a little bit. They're reducing the inflation rate, the way that the inflation rate is calculated for the cost of living adjustment in Social Security. I think gradually you'll see that Social Security will go down a little bit. Probably not a lot, but will go down a little bit, because the Social Security trust fund is grossly underfunded. So what we have is now more and more people are relying on a big bucket of money. So the need to save has increased substantially as Social Security has gotten a little weaker and private pensions have disappeared for most people. People can replace those private pensions by buying annuities, but hardly anyone does. Okay. So qualitative factors are important to consider when you're advising people who are retirees. A lot of people just make the assumption that they're going to be able to work until they decide they don't want to work anymore. That's not necessarily the case. Oftentimes, people who are older command higher salaries, and they may be more likely to get laid off when there's an economic downturn and the company needs to tighten the budget. And that means that they are more difficult. They may find it more difficult than younger employees to find work that would replace their find another job that will replace their income at a similar level. So that's something that we need to consider. And also people's health status. The primary earner in a couple may not be able to work because of failures in health, or they may not be able to, at least may not be able to earn as much. Other factors that people need to consider, I think this is becoming more important as time goes on, is that often people's sense of community and their interaction is related to what they do at work. If you can think about your neighbors, generations ago, people, went to the same civic organizations. They belong to churches. Now people, you don't work near where your neighbors work. You just happen to live in the same place. And so getting a sense of civic engagement or social engagement is difficult in the community, and people are relying more and more on work. Well, when people retire, that can be a bigger adjustment. So this is something that certainly needs to be considered, and you need to talk to your clients about that. This is not a math question. This is a matter of basically having people do the kinds of things that they envision in retirement, having them start to do those things and ramp up a bit to sort of practice retire before they actually retire would be a good strategy. But also, taking an assessment of how engaged your clients are with socialization and social groups outside of work. It would be something that you should consider. And so certainly the transition, of, hey, we're doing something, we're used to working and hustling, and people get a sense of meaning from doing that, and all of a sudden you have some people that experience what's known as failed retirement, where they go, they try it, they do everything they wanted to do for 6 months, and then all of a sudden the stuff that they enjoyed doing, the playing golf, the hobbies and stuff like that, when that's the only thing they can do, it becomes like work to them. They don't get as much enjoyment out of that, and they find out, hey, I want to go back to work. So that's important. So capital needs analysis. We've already done time value of money in this course. When you get to the retirement planning course, I'll drill down more on this, but I'm going to go over this at a basic level. So the three methods, in case people talk about these things, I would want you to know about it. There's the basic annuity method, which is the time value of money method, where you start off, hey, this is how much you need. We got to figure out how much you need the day you retire. That's based upon not needing any money, after you're dead. And so to live at a certain lifestyle, how much do you need at the beginning of retirement? And then we need to figure out, okay, if that's how much you need at the beginning of retirement, here's how much you have today, how much do you need to save each year? That's the basic annuity method. The capital preservation model would say, hey, if I retire with $1 million, I'm just going to live on the interest and I'm going to die with $1 million. So it doesn't matter how long I live. Hardly anybody does that financial planners do that from an approach anymore. The purchasing power preservation model says not only am I going to maintain, but my nest egg is going to grow with inflation. So that I can just spend interest only, and my income can keep pace with inflation. My purchasing power of my original nest egg keeps pace with inflation too. So, accurate assumptions. Really, I think it's important that we have accurate information with regard to how much our clients are going to spend. And not only that, we need to make sure to check with our clients that they're spending what we projected that they were going to spend and not more than that. If they're spending less, so shortly after retirement, we can do some replanning. But we want our assumptions to be accurate, but we don't know if they're accurate beforehand. So there's some things that we can do to deal with that. We need good information for what we can have that is what's known. And then as making assumptions about the future, we really just have to do the best that we can. And it's got to be based upon, where are we now? What have we seen historically? And maybe how do we think the future may be a little bit different than the past, and maybe if anything we want to err on the conservative side. But if we assume that our clients are going to live, say, hey, we're going to assume that you're going to live to be 110. We're going to assume that inflation is going to average 5% and your investments are only going to return 4%. What that means is that we might have to recommend our clients to have a more aggressive investment portfolio so that they earn more on their investments, and that they live in a shoebox, save 60% of so that they can save 60% of what they make so that they can finally retire at age 80. That doesn't sound like very good planning to me. So more than anything, we want our assumptions to be reasonable. We would love for them to be accurate. We can't know that in advance, but we want them to be reasonable. We don't want to be too conservative. So here's basically the basic capital needs analysis approach, which is the annuity method. We got to calculate a wage replacement ratio, or we can do the budgeting approach, either one. Wage replacement being the top-down approach. Determine the gross dollar needs before Social Security, the net dollar needs after Social Security. Calculate the inflated pre-retirement dollar needs. If you need $40,000 in today's dollars, how much is that going to be at retirement? And then calculate the capital needed at retirement. So here's an example of how this might go. I'm not going to ask you to do this, so I'm not going to show you on the exam. So I'm not going to show you an example of how this is done in Excel. If I ask you any of these sorts of questions, it'll be one question leads to another. I'm not going to have you do all 4 or 5 steps on your own. But let's go ahead and follow with this. Sherry, currently age 42, makes $70,000 a year. Her wage replacement ratio you've determined to be 80%. So we can already right there say, all right, if we're following these steps, she needs 80% of $70,000, $51,000 a year. She expects inflation will average 3% for retired life expectancy, and she expects to earn 9.5% on her investments and retire at age 62. 9.5% would be a pretty high assumption to make, particularly in retirement. But we'll just go with it. Possibly living to age 90. So we're making an assumption based on life expectancy as well. She was sent for and received her Social Security benefit statement, which indicated that her Social Security retirement benefit in today's dollars, if she adjusted for early retirement, would be $15,000. Let's say she retired at age 62 and started taking it then. By the way, this is just for a problem perspective. I would not suggest that clients take, unless they're in bad health, I would not suggest clients take money at age, take it to age 62. I would suggest, particularly for married people, if they're in good health, that the higher earning spouse defer until age 70. And women, single women, I would suggest to defer until age 70. Guys, it can get a little bit more dicey, but as a general rule, deferral is better because Social Security grows. The longer you delay up until age 70, it keeps getting larger. So it's reasonable to subtract the Social Security benefit from today's age. So she'll need, if she needed $56,000, we would take the $15,000 off to get to $41,000. So let's take a look and see what that looks like. 70,000 times 80% minus the 15,000 equals 41,000. Then we get into our time value of money calculation. So she's 42 now, plans on retiring at 62. 20 years from now, we need to inflate this $41,000 up to what it'll cost. How much will it cost to buy $41,000 worth of stuff at age 62? So if inflation is 3%, it'll actually cost $74,000 at that age to buy $41,000 worth of stuff. So if we need to spend $74,000 a year in retirement for 28 years, so which is life expectancy minus the retirement age. So this is the retirement RLE, retirement life expectancy, WLE, work life expectancy. So we've got RLE is 28. My inflation-adjusted rate of return, I use the inflation-adjusted rate of return because I'm going to earn 9.5%, but the amount that I take out is going to keep increasing with inflation. So I got to decrease in order to account for this. $74,000 is going to increase by 3% at age 62, by another 3% at age 63, by another 3% at age 64, so forth and so on. I need to account for that, so I use an inflation-adjusted rate of return, so which is about 6.3%. And then how much money do I need? This is kind of the key between the annuity model. We assume that we don't need anything to live on after we're dead, and then so we have the payment. We need the payment at the beginning of the period. If we solve for this payment, we would need to have, assuming the 9.5% rate of return, we would need a little over $1 million by the time we retire. Then we could also go through the steps of figuring out how much she would need to save each month or at the end of each year. Okay. If she had $50,000 already saved. So the capital preservation model, I'm not going to focus on the math on this. I explained to you what that is, that you're going to continue to have a future value will be the same as the present value. It will be the same thing as the present value in the life expectancy. And then we got the purchasing power preservation model. Okay. All of these things are based on assumptions, and we said, hey, it's important that our assumptions are right. We know that they're not going to be exactly correct. So one of the things that we can do, there are basically two things that we can do primary things that we can do to take this into account, as we can say, okay, what if we change some of the assumptions? What if we assumed that we weren't going to earn 9.5%? What if instead we earned 7%? What would that look like? What if we ended up living longer than age 90? What if we ended up living to 95? What would that look like? We can change the assumptions one at a time and say, okay, what would that look like? Small increases in inflation, and so we can just rerun the numbers, rerun the calculation using the different numbers. If inflation's a little bit higher, if we actually spend a little bit more, stuff like that. We can also do Monte Carlo simulations, which both the sensitivity analysis and the capital needs analysis, we're making assumptions. In the sensitivity analysis, we're just changing the assumptions and then running the same static portfolio again. In a Monte Carlo simulation, we might simulate 10,000 lifetimes and say, okay, what if inflation runs this way? What if asset returns run that way? How is that going to affect? And we know we're not going to get 7% every single year. One year it's going to be 9%. The other year it's going to be negative 10%. One year it's going to be 20%. The next year it's going to be 3%. The next year it's going to be negative 15%. The next year it's going to be 25%. So we know it's going to be all over the place, and they could be a series of bad years in a row. How would that affect things? So we run all these lifetime simulations and say what could happen. In most financial planners that our students go to work for use this approach, the Monte Carlo simulation approach. Sensitivity analysis and Monte Carlo simulation. Where you might see planners working using some sensitivity analysis is that if you're making an assumption that you're going to sell a business or that you're going to get an inheritance, but you're not sure at all what the value it is, maybe you say, okay, let's take that away and we'll rerun our Monte Carlo simulations to see how that worked. Or let's just assume that we had a bad sequence of returns the first 3 years in retirement and we're down 20%. Then we'll rerun our Monte Carlo simulations and we'll see how that worked. So it can't be used in a vacuum. The other thing is, even most Monte Carlo simulation doesn't take into account variations in life expectancy. So what you might do is say, okay, we'll plan to age 85, age 90, 95, and 100, and we'll know that we're a lot less likely to be alive at 100 than age 85, but we'll look at our probabilities of being able to fund all of our goals then. That's what Monte Carlo analysis does. So that's the end of this lecture. This is the last chapter that's going to be included on exam 2. There will be just a few questions focused on the basic things, and I have a review that I've recorded for you as well. And so if you pay attention to the things that are going to be on the review, you should do very well on the exam.